of capital in this industry, which is real estate. Uh, a lot of paradigm shifts here as well. Probably it is seeing light at the end of the tunnel. A lot of consolidation among developers over the past few years. Multiple fund cycles, but business models have changed, and private equity now. There's a glimmer of hope from the industry. It seems now that there's an uptick in the selling of real estate. So we have eminent panelists now sharing their views on what the experience has been like and how they foresee, in terms of an outlook, opportunities in 2022 and thereon. So we have in the panel Mr. Irfan Qazi. He's the Chief Investment Officer of Swami Investment Fund. Then we have Mr. Nipun Sahni, who's the partner at Apollo Global Management. We also have Mr. Vipul Rungta. He's the MD and CEO of HDFC Capital. We also have among us Mr. Sharad Mittal. He's the CEO of Motilal Oswal Real Estate. And to moderate the panel, we have Mr. Anuj Puri, Chairman and founder of Anirock. So with that, I would like to invite the panelist as well as the moderator on the stage, please. Welcome to you all, and over to you, Anuj.
Thank you very much, Rohan. Very kind. It's a super panel. Thank you to IVCA for putting this panel together. All the best speakers that you could get in the private equity. All my favorites are on the screen, and we've got about 45-50 minutes to roll through. I have some interesting questions to ask these panelists about what's going on within the private equity and the investment market. If I can, Vipul, start with you very quickly with what's going on in the stock market and with what's going on with Ukraine and Russia. On one side, we had seen a number of the developers wanting to get listed. And, we saw the Macrotech, we saw Shriram Properties. There are a number who are in queue. Do you think this is now going to take some time for these developers to get listed, given the circumstances of the external environment and at the stock market?
First of all, congrats on Anuj. I believe you have been sitting on the same seat since morning. So, but notwithstanding that, to your point, I think obviously there is going to be this is a problem. It is definitely something which is there. How soon it goes away is anybody's guess, but I think it's not going to go away so soon, because the problem is not going to be so simple to resolve. We are in a trickiest position and a geopolitical level, so it has its own reverberation. Problem from a larger perspective, we were having a very interesting discussion in the afternoon on a similar topic, and the whole thing is that forget real estate, which is still not as preferred from a developer listing perspective, even the entire tech world. Most of the members of IVCA, I think, will be having, and their investing companies will be having their own problems in terms of tapping the capital market. It is no doubt going to be tough win for some time, and capital is definitely going to be significantly more expensive. If nothing else, the risk weightage for any money that is coming into India, whether it is foreign or, for that matter, the return expectation of anything coming into unlisted securities, debt, equity, which basically means one bulk of real estate, it is going to go up. So if the risk weightage goes up, the cost of capital will go up.
And Vipul, you've been very successful in being able to raise capital and very successful in raising capital from international, pedigreed sovereign type funds. What is it when you go to them that they see? Is it India as an economy? Is it, the platform? Is it the team? Is it the prior success that you've had? Because I haven't seen someone in India who's sort of a machine in raising capital the way that you've been able to do and your team has been able to do.
No, I don't think it is that much credit to the team. I think first of all, it is credit to the platform that we have. We are the private equity arm of HDFC Group. It brings the prefix of HDFC solves a lot of problems as far as we are concerned, and a lot of other factors that you mentioned they add on. But 80% of it is about performance. It's about uh, apart from all the other things, I think it's about just being very, very straight. Like one of the things that we have been maintaining is that we cannot do high yield investments on the credit side. Cannot do 18, 19% investments. We want to do lower because we want to play in the mid risk market. And it's more about can we deploy a bigger chunk of money at a lower risk mid returns, and accordingly we have been trying to target if we can get some investors. And my personal experience has been that there are at least 8 to 9 investors that we know of who are very keen to deploy big chunk of capital provided the GP is able to at least prove to them that the risk is mid risk and not this 19 to 22% looking to last mile kind of funding, high IRR kind of stuff. It's not something which is in our DNA. So we are funding more of the mid, and they are ready to scale up their investments and commitments into India. We luckily have been we have now very strong interest from 3 or 4 investors who are keen to multiply, because for a lot of them it ultimately what matters is how much money are they making. Making 22% on $200 million versus making say 15-16% on say $800 million or $1 billion. It's a totally different ball game. But yes, what has happened in last 2 weeks will change these expectations.
Because people, if you take 14-15% and the way the rupee devalued, what we saw in the last couple of weeks, how would it really stack up to an international investor? Unlevered returns in some of the mature markets, you're probably able to get 8, 9, 10%. And when you compare that in dollar terms from India with the risk that the country has and the sector has, how do they think through this?
No, so it is going to be challenging. I think we were a little lucky that we managed to lock something in before anybody knew what Mr. Putin is trying to do, or at least our investors knew what Mr. Putin is trying to do. But on a serious note, I think it is going to be challenging. But there are ways now, Anuj. There are ways of financing the yield. You can lever it at an international level. There are subscription lines available. There are 2 or 3 ways by which you can maybe at the same risk level, at the same return level, bump up the returns. It maybe makes a topic of discussion for our next meeting. But yeah, there are.
Right.
I think the risk, just because the investors are looking at higher yields doesn't mean that the market is accepting those higher yields. I think market is
Good
going to
point.
accept lower yields because everybody's cost of construction is going to go out of whack. I don't know of a single developer whose cost of construction will be even within 5 to 10% of what he has expected it would be a year and a half, 2 years back. So we are in for some tough times.
Yeah. My last question, Vipul, what are the top 2 criterias when you look at investing with a developer?
Ability to give the money back to us, because investing is 2% of my job. 98% of my job is to get the money back. And I think uh, that ability reflected in transparency. As an individual, we look at individual, because most of the developers are individual driven, or maybe a combination of 2 or 3 people. So if there is transparency in the nature of the individual, It's something that we are. It's a big positive for us. And B, I think a track record. Now, market has pretty much got bifurcated between who is intent wise okay and who is not. So a positive intent guy who is in a little bit of a stretch is the ideal guy as far as we are concerned. Positive intent and is not stretched does not work, and negative intent does needs money again does not work.
Super. That's pretty clear. Thanks, Vipul. Nipun, if I can come to you, you've invested in various asset classes, and you're amongst the few who have explored a lot of asset classes, even beyond the residential. Which ones? So the first question is, which ones do you prefer amongst the asset classes? And second is, Nipun, there are newer asset classes that are emerging, which is data center, warehousing, industrial. Is that of some excitement?
So I think there's very difficult, not one answer. I think depending on how you view risk reward, you have to kind of figure out the strategies accordingly. If you see broadly in India over the last 10 years, the one question we got asked at every panel, and it was a topic of discussion at every conference: when will equity come to residential markets? Never come. It's just not come. In 10 years, you can take all the people on this panel and everybody is investing in the residential sector, but there's no equity capital. So I think capital has many shapes and forms, and the kind of balanced risk reward sitting in the market. If you take the office sector, it's the inverse. You know, it's not been able to. It's attracted all the equity capital. So you've consolidated portfolios, bought, whether it's IT parks, which have gone on to do REIT listing. So I think the broad theme, even globally, and India is maturing as a market, is that assets which are going to generate regular income, annuity income, it could come out of warehousing, it could be from data centers, it could be offices. Wherever there is annuity income, there is equity capital, which looks to kind of go into that, because your value is really getting created at the rare end through creating these portfolios. Residential sector, on the other hand, is all about cash flow. It's all operating cash flow. And I think that's getting played through the debt markets very clearly. So it's debt for resi and maybe equity plus debt for all the other sector, and nothing in specific to India. I think you can map it almost globally. The capital formation in India is very challenging. Domestic capital for equity, uh, I don't think it's worth mentioning. What's the domestic capital collectively raised for equity other than capital markets, which probably had a short window, but it's been very difficult to tap for most of the sector in the last few years. So this window, it was probably lasted a year, and it's again becoming challenges. I think government has large plans on the LIC IPO. There are a bunch of other sectors lined up. So I think real estate will, if there's momentum, it'll kind of go through. Otherwise, it'll find it again. So broad theme being, equity is a tough one for residential sectors, just because of operating cash flow and all the things, complexities associated with it, and also regulatory. Today, if you are equity, you have to be responsible for all the RERA, and you kind of come as take on all the responsibilities of a developer, which I don't think most funds can really, because they're limited life funds, whether they're 4 years or 8 years, but just limited life doesn't allow you to give these long 5, 10, 15-year indemnities that are required from equity partners. So that's very structural to the Indian market. But overall, I think on the new emerging asset classes, if you the two big ones are really logistic warehouses and data centers. Both India is just a starting point. You should, these are where office was 10 to 15 years ago. So just starting out, I think office has gone on to become very mature and very consolidated sector. Early days for these. I think it's a long haul. you're probably in the beginning of a 15-year cycle for both data center and this. So some investors want to get in early, and some will kind of keep coming along the way as these portfolios mature, as consolidation happens. But a long way to go. I think we've been active on this on the logistics side in China, and it's I probably don't have like exact numbers top of my head, but I think it's like India is still just I think 50 or 60 billion of e-commerce, and China is like more than 700-800 billion, right? Like we're talking of 800 or 900 billion. Their GDP is at 10 trillion, so you're really looking at 800-900. So India has a really long way to go to develop the logistic infrastructure, and similarly on data center side, I think we're at very early stages.
One very quick thing, Nipun, on the residential market. It is crying for equity. I know there is debt that is available, and you rightly pointed out, but it is crying for equity. And there were public markets that had started to open up. Maybe they'll open up again once things calm down. But tell me, on the international markets, is there equity that goes into residential, or they face similar problems as what we face in India?
Very similar. I think markets consolidated. If you take most of the mature markets, they've consolidated with a few large developers. India is a really large market, so it's very difficult to compare it in terms of number of developers. I think it's you will have the numbers better than us. The number of developers who are doing residential in India, that's going to consolidate. We always knew that it's proliferated without any entry barriers. Almost in every city there was a CREDAI body, and there were hundreds of developers in every city. That's unsustainable. So yes, in a market like, if you take single city markets like Dubai, they're countries but they're cities. Singapore, Dubai, Hong Kong, or you take countries like Australia, Japan, the top 10, 15 in the single cities, there you just have 5, 7 big names. But in the even the larger countries, you'll have a bunch of big names in each region, which are really controlling most of the market. And in India also, consolidation is underway. Those who have equity can grow faster for residential, and it's already playing out. Whether you tap it through capital markets, or you are large conglomerates who have started real estate businesses, whether it's Tatas, Mahindras, Godrej's, Adani's, they're funneling capital to start new verticals. So I think that seems to be the model in India. As far as international capital goes, I don't think there is a bias to India really. It's operating cash flows, and debt can play it much more flexible than equity, and the returns are not meaningfully different for the two unless land has been bought on the cheap. So it's continue to remain a challenge, and it's lined with what happens internationally.
Got it. Asia is a growing market for real estate, particularly on the capital side, Nipun. And I just wanted to understand is that, how does 2022, look for the overall PE funding into real estate for India, given the revised geopolitical, situation? Is the investor confidence in India improving for real estate?
So again, I think investors have picked their own strategies. There are very few investors who are doing everything. I think people are either picking credit or office, or maybe high yield. And then obviously there's all the credit side of it. But it's at a very micro level. Even before what's going on right now because of the Russia-Ukraine situation, the Evergrande moment in China had already impacted the broad sentiment in the region. China, and thank God that real estate markets are local. That spillover did not come here. All of us here have raised funds despite that being the backdrop of the largest global market for real estate for residential is China by far. So it's so local that despite that, I think funds got raised by all the players, whether on this panel or otherwise. For India, yeah.
But if I may add, Irfan owes his organization to the Evergrande movement of India.
So I think what will be interesting to see is why has government kept the tap shut for domestic institutions to start participating in the story. If we want capital formation to happen domestically, it cannot just be left to family offices and HNIs. It's very shallow. No world market has got developed without institutions. Uh, you know, Managers like Motilal or other domestic managers, they can easily raise significantly more capital once institutional investments are allowed. So I think somewhere the government can take a look at trying to release some allocations from pensions and insurances, companies, etc., for the sector. And it ironically, the volatility in the stock market is the highest. People think real estate is risky, but ironically, real estate asset values have been the most stable. Even during COVID, very little volatility. It's actually gone the reverse. Residential real estate has probably moved up. And that's why I say that domestic capital formation can only happen when domestic institutions are allowed. International capital for 22, too early to say because of what's really happening is just a few weeks old, but funds mandates are for 4 to 7 years, so we anyway take slightly longer term views. Geopolitical risk cannot be part of any Excel spreadsheet. You cannot model geopolitical risk, and it's the first time the world is probably facing something like this after the World War. So we hopefully can get contained. Nobody has it's just very, very difficult. You have to monitor the situation. If it is localized and it's between two countries, then life can go on as usual. But if other countries start getting dragged into it, then it takes a very different situation, right? It's not about investing in real estate or investing in equities. It kind of just takes a much broader sectoral issue. India, I think the inflationary environment is going to become definitely worse. Oil is already at $130. We import more than 130 billion of oil. It's more than 20% of our import. Anybody can do the maths and see how it hits into GDP and the ripple effect that has into everything. Like everything starts with oil, and anyway, the government had hiked this oil multiple times last year to fund COVID related deficits and impact on the economy. So overall, I think we are in a very inflationary kind of environment, and hopefully that will keep the central banks to not increase interest rates. Or will they do? It's a very, very, it's a big conundrum for central banks worldwide. Do you cool down inflation by increasing interest rates, or do you kind of keep it there and accommodative stance? So it's uncharted territory. And that's why I think in this one, uh, strategies, defensive strategies might outperform aggressive ones, at least for the time being, and then you can reset the clock if there's more stability.
Fantastic. My last one, Nipun. Has the typology of deal flow changed in the last 5 years?
I think there was sectorally, there was a big bias towards office earlier, and clearly we've seen much more activity and capital formation happen on the residential side. Earlier, it was largely NBFCs which were supplying capital to Resi. But if you see the pools of capital on this panel, whether it was Swami or SDFC Capital, ourselves, etc., we are a creation of the last 5 years in terms of providing capital through the credit funnel into this segment. And I think that's probably expected to continue. The shift in the asset class from, I won't say it's a shift, but residential is front and center. It's the largest part of the asset class. And within that, it's really credit solutions. People are trying to provide solutions of capital rather than a straight jacket amortizing loan fully with standard covenants. So you're really trading, simplifying complexity and trading pricing for flexibility.
Super. Sharad, if I can come to you and just continuing with what Nipun said is, I quite like the way that he said is that the capital formation, if you have to do domestic, is not going to be possible unless you've got the Indian institution contributing. I mean, just getting the HNIs and the family offices is very difficult to be able to do that. And you've been doing this difficult job. How's that experience been?
So I would agree with Nitin. So when you look at HNI and family office money, I've been doing it for 15, 16 years now. And at Motilal in last 9 years, we have raised a bit of capital. It's a hardworking model. You need to manage the expectations of local HNIs. They are closer to the market. And for whatever reason, when they invest into real estate, they don't look at risk-adjusted return. They want absolute return. That's the mindset. But having said that, I would say the pockets have gone deeper. As the country is growing and as we are moving from 1.5 to 2 trillion and hopefully to 5 trillion over a period of time, that is a large pool of capital. It may be a hardworking model, but it cannot be ignored. As far as domestic institutions are concerned, I think it's a slow process. If you really see from a regulator perspective, one part of the capital that comes in form of a debt is through banks and NBFCs. Regulators have been very, very cautious on how that money comes to the real estate sector. Some of the other and domestic institutions, when you look at it, is largely state-owned. When you look at insurance and say mutual fund also has a lot of retail money, I think it will take time. And if they have to start, they would start dabbling into asset classes which are less riskier or perceived to be less riskier, like REIT or rental yielding assets. I think journey would start from there. And I would agree with Nipun that that journey needs to start. Money coming into more underdevelopment or development assets is probably take time. But I think in rental yielding assets, especially with 3 REITs which are listed, I think there is more money that can come in and they can experience how an institutional framework works within a real estate sector. And I think till the time that happens, which in my mind is 3 to 5 years journey, I think the pool for the local money is only growing, at least from the family office.
And Sharad, is there expectation of return not on the higher side? And we heard Vipul speak about that it is difficult in this market to be able to generate the kind of returns that may be desired. Certainly from an HNI, because they have so many other options to be able to invest. And then does it then start to breach into a higher risk, given that the expectation is a lot more higher on the returns?
So I think it's higher. Like I said, they look at absolute return when it comes to real estate rather than looking at risk-adjusted return. But over a period of last 2 years, the real estate has seen recovery. Also, the returns on some of the other asset classes, you look at debt forms the largest part. India's in HNIs or retail investors' portfolio as well, the debt forms a large part. Over a period of last 1.5 years, those returns have collapsed. The FD returns have come down to 3-4% pre-tax. Some of the other more preferred ones, which are through mutual funds, those returns have also come off. So return expectations have come down, but I would still say that they will be in mid-teens. The other challenge, Anuj, here is that when you raise local money and invest, the taxation is not favorable. You end up paying maximum marginal rate. Comparing it to some of the other avenues through which local investors can put in money through mutual fund or some of the other asset classes. There is one more form through MLDs. There the tax advantage is there. So I think we have been kind of putting it across. In fact, with Nipun and Vipul and some of the other ones in the IVCA also, we discussed a couple of months back that there needs to be parity that need to be brought in. If you have a 40% plus tax, no amount of return would be able to justify a return in the hand of the investors. Having said that, last 1.5 years, I'm seeing a change. The positive news flow and the recovery in the real estate market is giving confidence to the local investors that it is an asset class which cannot be ignored.
Sharad, is there a thought that you're going to go into some of these tier 2, tier 3 cities? Majority of the funds have largely contained themselves to tier 1 cities. Do you think that ever Motilal Oswal will want to venture into smaller cities, or we think that India is only tier 1 city?
So Anuj, we are discussing about capital markets. We're on IVCA platform. I'll draw a parallel with equity markets. So you have in mutual funds, you have stocks which are large cap, mid cap, small cap, and micro cap. The way Indian real estate market is structured, the large 8 cities are large caps. Then you have a missing mid, you have missing small cap, you have micro caps. So the middle is missing. So if you look at, this is a country of mega cities. 8 cities accounts for 75% of the real estate activities. And then there is no mid cap, there is no small cap, and then micro cap. And in those cities also, the quality of developer, their ability to take large capital, their ability to understand the private equity part of it is limited. And I think over a period of last 2 years, the way we have seen the recovery in these 8 markets, and there is lack of capital, like Vipul also spoke about and Nipun, the way the NBFC crisis or the IL&FS crisis played out, there is a paucity of capital. Right now, we are focused doing business in 8 cities. To expand our investment funnel, we have started looking at very selectively started looking at some of the tier 2 cities. And there the idea is to work with the largest developers in those markets. We have done 1 transactions with a developer in Chandigarh. After doing that, the amount of effort which was there to put out the smallest check that we ever written, it then boils down to effort versus the reward. But idea is to focus on top 8 cities and keep looking at some of the other tier 2 cities. The key there is there migration happening in those cities? If they are dependent on old economy or upgradation from old houses to the new one, those are not the cities that will be exciting. If there is some bit of migration, new jobs getting created, service industry coming in there, doesn't seem very exciting. But I think if I have to sum up, I think top 8 cities will take most of the capital that we have.
I'm going to ask a little sensitive question, Sharad. We have very pedigreed platforms on the screen, but we've not had very encouraging results from many of the private equity funds in the past, particularly those who had invested in the real estate over the last few years, and we haven't seen the kind of returns what 4 of you, barring Irfan, have been able to do it. Irfan's agenda is very different, which I'll come to. What is the difference between the success of good quality managers versus those who were not able to deliver the return? The color of money was the same, the opportunity appeared the same. What was the differentiation?
So Anuj, it will be very difficult to comment on anybody else. I can talk about what we have been able to do a reasonable success. I think first of all, I believe it's about the choice of strategy. What's the strategy? Every fund manager, they know the market and they have raised capital, and it shows that they have an ability to raise capital and deploy. I think it's a choice of strategy which plays out. I think first is the strategy, second is the team, third I think is the alignment of team. I think, Anuj, this is extremely important. When I look at some of the global peers, one of the key reasons is that there is an alignment of team from a long-term perspective. Somewhere I believe that in the capital which was raised over a period of last 10, 12 years domestically, alignment was not as deep as it was required. Second, the choice of strategy went a little wrong. Primarily, for example, for us, when we were writing down our strategy in 2013-14, we said we're going to remain very light on Delhi and Bombay. That was primarily one big item in the strategy. I think the third piece in this is the asset management. It's the hard-working model. Unless until one is able to get down to the ground and work with a developer. See, on the return expectation is late teens to early 20s. That's the return expectation, which is more than the equity returns that mutual fund has done in last 10 years. If you take up funds from 2010 to 2020, the best performing funds will be early teens. Here we are trying to generate returns which are significantly higher, which would mean that the governance and involvement has to be equity-like. Structure could be a debt-like. You can have protection which are debt-like. So I think the asset management part of it, So I would say strategy, team, and then the bottoms up approach of managing the asset as if you have done an equity into the project.
I mean, that is a great segue, Irfan, coming into you. I think I can rattle out a lot of statistics on Swami Fund on your behalf, Irfan. 60,000 units funded, 9,000 delivered over the next 3 to 4 years. The balance are going to be committed. Fantastic. Certainly in the NCR region, Irfan, there is a lot of confidence building that has happened with the Swami Fund, bringing in the money to be able to complete the homes which had been left unconstructed, incomplete for years. Not only that, those homeowners got their homes, the confidence within the real estate sector has really improved, and that the excitement that comes in with the way that Swami has been able to brand itself with the developers is amazing. The point that I wanted to pick up, Irfan, was really where Sharad left on this asset management. I just want a little bit understanding on Swami, the way that you asset manage, because I think your asset management definition is perhaps different to some of the others' asset management. Sorry, you are on mute, Irfan.
Hi, Anuj. The professional hazard of speaking to you every day is you take away all my talking points, right? So you know the sport, you know all that. But that aside, like I said in a webinar yesterday or a few days ago, what really matters to us is we are trying to do only two things. One, provide adequate capital at the start, and two, to ensure that the entire capital goes into the project we are funding, right? That might sound so simple, that might sound obvious, but there's a track record of funds not being used in the project, especially that part. That funds have been, diverted either for other projects or diverted for personal reasons, or whatever the reason, it is a diversion, and the money collected from home buyers in a particular project have not been used in that particular project. And that's where Swami tries to be different. That's where we've adopted a drip irrigation method. We are extremely liberal when it comes to sanctioning funds for a project, and we have this, we are very tight-fisted. We have all our controls are to ensure that funding is done to the extent possible. So the first rule we start off with is we'll be doing reimbursements only. We will be funding reimbursements after we have checked that those are expenses that have been done for that particular project. And how do we ensure that? Instead of having a PMC that visits a site once a month, once a fortnight, or once a quarter, we have a PMC representative that is stationed at the site. So we have a daily report on expenses, inflows, material coming in, labor mobilization, etc., etc. So we are in a better position. We are in a more informed position to fund reimbursements of expenses that have happened at the site. But that's just one. Does it mean that we do not do any kind of advance funding? No, we do advance funding as well, because that is the nature of the industry. Advances are required so that the developer can get substantial discounts, or for customized products, it is an industry norm to give advances. So we give advances and we keep a close tab on it. What we do is we have more than one level of control. So one is at the PMC site itself, the other is within the team. So we have one individual looking at maybe 2, 3, or max 4 projects only, and then looking at all the invoices that have been cleared by the PMC representative, checking them against the technical due diligence and the cost estimates that we had received before we actually invested in the project, and only then clearing them. And same rule followed. Discourage cash expenses, discourage advances, encourage banking transactions, and keep a tab. So that's one. The other level that we've gone to is all the payments are done directly to the vendor. All the payments are done directly to, if it's a rehab project and there are tenants, all the rental payments are made directly to the tenants. All the payments to the various suppliers are done directly. All the employee expenses, all the salaries are paid directly into the employee accounts, right? So at any one point in time, and that is possible today, it might have been difficult earlier, But with wire transfers and the trustee doing the wire transfers, it is easily possible with some level of effort. So all the expenses are paid directly. Very little flows to the developer's account. In fact, in most cases, except for tax payments, where the money is deposited into a developer's account, and the next payment is released only after we get the challan or the invoice or whatever for that payment to show that the payment has been done. So in a way, our team acts as a project CFO, not as a lender. And we are in, they have a complete understanding of, what expense is required, where is the expense currently being funded, what next, and so on for every part of the project. So it's a project CFO ownership kind of a role, and that's asset management for us.
Hey, Irfan, I do want to bring Vipul on this one. Vipul, sounds like very intense asset management, very involved CFO role, as Irfan put it across. What would HDFC Capital do in this part compared to what Swami is doing? Is it similar approach that you also follow?
Very, very, very similar, except that we have a graded approach. We divide all our investee companies into 3 grades, and we have specific asset management approach depending on the risk that we attach on the development cycle, because we invest across the entire development cycle. Sometimes the granularity of what is the technical aspect of the project may not be so relevant, depending if it is significantly ready or if it is unlaunched, and so on and so forth, because we follow a bouquet approach. But yes, how Irfan very beautifully explained, I can't explain that way, but yes, we are doing about that for what we say is our high risk investments, which is about 70% of the portfolio. 30% of the portfolio, we would have a slightly moderated approach.
And then Vipul, very interesting, because this wasn't the case earlier with many of the other funds, who had come in. I'm talking way sort of 2005, 6, 7, that sort of genre. At that time, you would never have this kind of involvement where you would actually be sitting on top of the developer. At that time, it was largely a check that was written and then managed through spreadsheets. Very, very, very different approach. Irfan, just coming back to you, a couple of more questions I want to ask. Has the deal flow increased, decreased, remained the same during this COVID time?
So the good news for the rest of the industry, the not so good news for us, is that the deal flow has actually decreased, right? We are a distress fund. The distress in the environment has significantly decreased since the time that we were launched in 2019. So, that was the dark age for, just at the start of 2019, when, NBFCs were going through a fair share of trouble, more than a fair share of trouble. Most of the funding for real estate had happened through NBFCs, and that supply line had got throttled. There were a large number of unfinished projects, and that's when Swami came in. And, because I live, breathe, and eat Swami all the time, I like to believe that Swami has a large role to play in reducing the stress levels in the industry. But this is an objective opinion from someone who works in the Swami fund. Instead, what I can give you are stats rather than an opinion. So we've done about 108 deals, like you mentioned earlier, right? Just let me give you a context to 108, right? 108 is more than the number of deals done by the rest of the PE residential industry. So just one fund has done as many deals, or probably more, than the rest of the residential real estate industry in the last 2 years. And that's how, that has reduced the stress in the industry. So that's one. But it's not just this. I mean, the government has taken, several steps to be proactive here. So apart from Swami, even the emergency credit guarantee scheme that was introduced helped reduce a lot of stress from the developers. And then various state governments, reduced stamp duties in various important markets, and that itself also helped reduce the stress. In fact, what happened was a culmination of a few factors, right? The fact that interest rates were at a historic low, home loan rates, and therefore affordability was at its best, and COVID, inspired people to not just inspired people to buy larger houses and better houses, because a home wasn't suddenly a place where you spend only the night. You spend, your entire life here, the day and the night. But COVID also reduced the supply in the market. So that again helped the developers. So all that is good news, and that is especially good news for the larger developers in the market who got, not just a bigger share of the pie in terms of larger number of sales and better customers walking in, but also got capital both from private equity as well as public equity sources, right? So all good for the larger developers. I think the situation deteriorated or worsened, to a very large extent for the smaller developers. So they have been left out of the market. It is not like the entire market has improved, but definitely, if you look at it broadly, the market has improved. Our deal flow could be considered as a leading indicator of the state of the market. Our deal flow has definitely reduced.
Last question.
I have no comments on how the new COVID in the market,
But
right? Which is the Ukraine-Russian.
Anuj, we should use this platform where all the funds are there. Then we should ease the problem that Irfan has of reduced deal flow. We talked about co-investment, and I think the previous platform we were talking about fund of funds. So Irfan, if you can talk to the right thing, it may make a lot of sense. I think everybody else, Sharad, Nipun, and we can look at a situation where you co-invest with us into this thing, and we can actually make do that the overall return to the investor will be significantly better risk adjusted.
So
That can probably be a good takeout of this entire conversation.
And
definitely.
yeah.
Sorry.
No, go ahead, Irfan.
So definitely, I mean, that's the approach we are taking to. So lenders have an issue in terms of seeding charge, and that was a big issue, and that was in fact we were wondering at one point in time whether to launch the fund or not without clearing that issue. We decided to go ahead because not everything can be solved with the same brush, but you try to clear as much of the problem as possible in any case. And we are glad to report that about 58 of the 108 deals we've done are where lenders have ceded charge. But that still means that there are a large number of deals which we couldn't do because the lenders were not willing to cede charge. And something that Vipul has suggested, another lender, another investor coming in and buying out the existing lender, etc., might increase the deal flow that way.
I wanted to comment. See, it's so interesting, the situation. When you had the best times, and we on this panel have been part of the industry for a long time, the best time was considered the late 2007 onwards to 11. Despite that produced the worst results for investors. And 2018-19, the worst times, and you add the blow up of NBFCs, the crisis caused by COVID, the worst time I think is producing the best result. So, the creation of the Swami Fund, and credit to Vipul, he was part of that whole architecture to do that. And then the execution, the worst time, it's never been a better time. The industry, I think, for the first time in residential has never felt more confident, collectively as a sector, coming out of COVID, multiple crises, but coming out of it in this manner. It's a Houdini act. It's like somebody had told you in 2019 that this could be possible. And then there's this COVID when 10 months there'll be no construction, no sales, people will not go. It's when I'm hearing it and believing it, it's taking me time to digest also that collectively, if people put their minds to the problem, I think the government acted on time. A lot of smart decision making happened. And I think there is definitely maturity and more sensible things happening in the sector. Whereas back in the days, I think there was a lot of cowboyishness at that time. So clearly, I think looks like all the stakeholders have come together to create this environment.
Yeah. And then Nipun, sorry, Sharad, go ahead.
Saying is actually very encouraging. So it might get a little difficult deploying capital, but eventually the sector needs to do well. And if he's saying the deal flow is slowing down, and that we are seeing in our portfolios as well, that money is coming ahead of the time, say 70-80% of the portfolio, the money is coming much ahead of that time. It's actually encouraging. It will help the sector to come out of a really long 7-8 years of extremely tough period, and the unwinding of debt. And there is still a lot of overhang of the debt on the sector, and that might take a couple of more years, and then we can look forward. I also wanted to ask you, Anuj, because you are the closest to the ground as compared to all of us, given that you must be the largest real estate seller in India. What is the sense that you have looking at the residential market? We are looking more from a deal flow and our project.
So Sharad, we are certainly finding that the sales have improved dramatically, particularly for good quality developers. And when I say good quality developers, it's listed and leading unlisted developers. I don't think the market has increased as much as the share of this good quality developers, unlisted and listed, have increased. So basically, they are having somebody else's lunch. And that's where we are starting to see that this improvement in the sales, and this is what we're hearing from you, Sharad, saying is that the monies are coming back before time because sales are doing very well. And this is what we are hearing from Irfan, that we're not getting as much sort of deal flow coming in. But on the other hand, Sharad, there are a number of BC grade developers whom you actually guys haven't funded, so you don't know what's going on there is. Their sales has come to an absolute standstill. This wasn't the case in 2000, Nipun, the period that you mentioned, 2007 to 11. At that time, Sharad, the buyer was not discerning. So they would go to the developer who was giving them cheaper, who was giving them 10-15% cheaper. Today, next door wall, one good quality developer is selling at 15-20% premium. You go to the buyer and say, why are you not buying it with this developer? Same boundary wall. He says, no, I don't want to buy it from this guy. I don't know whether he or she is going to be able to deliver it or not. I don't mind paying a premium for a good quality developer. And then you say, but there are all the regulations, there are all the compliances, there is RERA. I mean, the answer of the buyer is, so what? You're going to put the developer behind bars. I'm not going to get my apartment. That's where the segregation has really started to happen. And that's what, we are seeing. And hence, to your point, Sharad, you are starting to see money come back from these good quality developers to whom you had lent money or you had invested with them. Had you invested with the sort of C grade developers or B grade, I'm telling you, you wouldn't have got the money back.
Yeah.
Anuj, can I just add to that? Even with those developers, we are seeing, and to some extent, we like to attribute it to the Swami involvement. But we are seeing, similar to what Sharad mentioned, we are seeing redemptions already happening with our investments. Money coming back in many of the projects. Now, I cannot share some exact numbers here, but money coming back in many of our projects that we had started about 1.5 years ago. To some extent, we attribute it to the market. To some extent, we attribute it to the alpha that we are generating as a credible funding source, and therefore buyers walking in and collections improving as a result of the Swami improvement. But regardless of whether it's that alpha or the market beta, we are also seeing money starting to come back for us, which means that the cash flow position has significantly improved.
Good point. Nipun, last question. We're going to run out of time. It seems that everything's going on well within the Indian real estate, at least in the residential side. It seems that it is, in a little bit of a safe zone. From a private equity real estate, what do you think can go wrong from here on?
See, I think the geopolitical is right front and center. I think it's sitting right there. Cost inflation is already underway. One of my fellow panelists commented how the input costs are going to put an upward pressure on the whole situation here. The interest rate environment has already probably bottomed out. it'll be very hard to reduce mortgage rates from here on. So I think you add up all of that, and there's no room for complacency. Active asset management, plus all the other tools that collectively you have to put your head around to make sure that you can mitigate some of these. But it's all there. Risk hasn't gone off the table. I'll just stop at that, mindful of time, and want to thank all the fellow panelists, and always a pleasure to be grilled by you, Anuj. Thanks.
Thank you very much. It's a fantastic panel. Didn't realize that we'd run out of time. I think you summarized it beautifully as well, Nipun. What we are finding is, perhaps 5 things: geopolitical challenges, which all the businesses are looking at it. Second is, particularly with the real estate, we're seeing the inflation. And Vipul, to your point, I completely agree. I think everybody's plans on the construction cost would have gone haywire. Particularly with steel, cement, and then now the oil going up. I love the dialogue, Nipun, that you put it, that it's better to have a defensive strategy rather than an aggressive strategy at this moment in time. Makes a huge amount of sense. I've been reading it as well. Many people are saying, even on the stock market, have a defensive strategy currently rather than going aggressive. And the last 2 things, consolidation is very, very visible. And we are seeing that, stronger getting stronger and weak are perishing. And the last one, to Irfan's point, that active asset management is the only way that you're going to see more success with these platforms. So really enjoyed. Thank you very much, Vipul, Nipun, Sharad, and Irfan for spending the time. And I hope that the audience got the maximum out of this panel.
Thanks, everybody.
Thanks, Anuj.
Thank you so much. Thanks, Anuj. Thanks, Vipul. Thanks, Sharad and Nipun and Irfan. Brilliant views. From a vantage point, if one wanted to understand how real estate as an investment is, and from a novice perspective, all your perspectives, I could clearly understand that we need to keep our fingers crossed so that the geopolitical risk mellows down. We need to keep our fingers crossed that the liquidity remains in the market. But at the same time, if we want to buy real estate, we need to look at the consolidated market and the top players which have equity. So, summing it up, but, just wanted to thank about all the different perspectives that you brought onto the panel. So thanks very much for taking out time and sharing these views with the audience. Thank you so much.
Thank you.
Thank you, Rohan.
Thank you.
Bye. Bye.
Bye.